let's see here, SPY. So I'm looking here, just trying to look to say, okay, if I look at the 405 range to 430 range, 405 to 430. So I'm in this sort of box. The SPYs are right here, 436 and a half. 436 to 430 is 1.5%. So we're in that range where we're looking at puts. You could see July, there's a significant amount of open interest. So we had that big downdraft. It caused everybody to come in, get loaded up on puts for July. Hasn't worked out. The stock has kind of made new highs. And, they're stuck here at you see how they stopped, right? In July, it's like we're here. They stopped buying puts. People have given up. Do you see that, Marco?
Yep.
Okay, so they're buying a little bit here in the front month and the front days and the weeklies and the dailies and whatnot, but they've sort of given up. Okay, that's clue number one. Clue number two is after Friday next week, you start having again very little put spreads, very little. Again, not saying that things going to crash, but very little put spreads. If we go here, sure, in August, 1 month from now, in August, we have only at the 425 level and the 430 level, 20,000, then 420, 60,000. I think now is the market's giving you opportunity. We had the 420, 405 paid fairly cheap because skew is actually in our favor. That roll now, just rolling the 420, selling the 420s, buying the 430s seems to make a lot of sense. And to do that, we have, let's see here, July 16. I'm sorry, August. We're looking at August. It's not going to cost that much here. It's just not going to cost that much. So the 420s, 330 and 430, 330 and 5. So for $1.70, you get the 420 up to the 430s, $1.70, 830. The most worth is 10. So $1.70 is what you would pay. You can make that 830. It's almost 5 to 1. So you see the way they are essentially pricing these things. When this thing right here, you see how this is all the way over here?
Yeah.
Okay, that means the downside puts are more expensive. The downside puts, this is skew leaning bearish. The downside puts are higher, but so you can get, that's why this trade looks so good. This put spread, right? For $1.70 to get, you're talking about, think about this. You're talking about a 1.5% lower gets you to the at the money. And then if you get 2.5%, 3%, you basically can make 4 to 1 on this trade. That to me is, it's basically telling you that the market's sort of telling you that it can't go down. And so we're leaning on that, but we don't want to be just left hanging with all calls. So that's something that's interesting there. Even if you don't have a position, the 420, 430 in August at $1.70, I think is a good little hedge or a good little, pocket of risk that you could sort of hedge right there. Okay.
Okay. Nice.
So let's keep that in mind there. And I'm looking at Apple and Microsoft a little bit weak, but the market, it's pockets. It's odd. There's a lot of, over the course of the last couple of weeks, there's a lot of shifting and moving around. But this is what I'm seeing, at least as a hedge, that I think is good for you to have. All right.